few days, we do get a push down to that level. But you remember that the loss that you might have on that second contract that you traded is offset in great part by the gain that you have on the first contract. So the question now is, how flexible do you want to be? You're convinced that this is a long-term trade. You're convinced that everything's going to go higher. So you might want to use, once it's been established and the market has started to, kind of move out of this little wrinkle right here and kind of started to move up here, you might want to take a situation where you put this stop and put it below the last stop. This is kind of the way the traditional technical analysis would approach the situation and put their stop somewhere in there to make sure that you allow yourself enough leeway to hang with that trend as it develops and moves upward as you expect. So it makes its move, it does its thing, and again, we have a situation where the market, after trading a little sideways, a little bit up, we still can't get too excited about this uptrend, but at least it's up from our initial position and our little base position. We have a couple of contracts, and we're still okay. Then we get a pop-up right here. We have a predicted high on August 28th at 951, so we buy at 961, and that puts us in a position right here at 961 right in here where we now have contract number 3. Again, the whole process as you go along is assess what is the profit, what is the risk. You kind of see what the net effect of all these various positions is and where you would want to place your stops based upon the amount of risk that you're willing to accept. As I mentioned earlier, we're talking about trying to limit our risk, in this case, to no more than $1,000 per full-size gold contract. And so far, as the market keeps moving up, looks like we can be able to do that quite well. And again, we're now going to refer back to our traditional technical analysis. We're going to put our stops below there, below that last previous low, and we're in a position where we now can write it up. Again, you can use the, if you get really anxious and are not convinced that this is going up, you have your predicted lows as you move up here, where you can use that as a point, as a reference point for where to place the stop, like $10 below the predicted low. But what you want to do is you want to stay with the trend. You want to ride the trend. You don't want to give up on it just simply because there are a few little dips and things as you go along. So that's kind of the first stage of the trade. We know now that we have a 3-contract position. We're doing pretty well with that trade, and so now we're going to enter into another phase, and that will be the phase that kind of does test our mettle a little bit, because when we get to that point, it raises some real questions. Are we going to stay in? Are we going to get out? Because the dips may be more than we can take. Now we're going to move into the second phase of that. Again, this just gives you an idea what that looks like as far as the triple cross is concerned. When you see what is going on the screen, you can see that we have suddenly, this big black candle that you have here, and I don't know if you recall, but that was about the time we were having some issues in Dubai with their debt situation and their sovereign funds, and everybody was a little bit shook up by that. The gold market definitely affected, and so you had that downdraft that occurred. You had, in this case, you had a doji candle top. We had hit a high at that point in gold around 1220. Everybody was a little bit nervous. We doji tops. That means the traders opened the market, traded up, traded down, and closed the market at roughly the same price. Not always a convincing argument for a top, but you'll notice a number of times where a doji appears at the top of a market. So it's always kind of one of those candles that if there's any candle that you kind of want to observe for providing some clues, it is the doji candle, because it can show you some of the turns. Now we're going to switch over again. You can see, kind of get a visual picture here. Here's what the triple cross looks like. Here's what that thick green line, the longest term trend looks like. And you can see in this case it's starting to kind of move a little lower, moving sideways. But remember, you are convinced that the overall longer term outlook for gold is going to be up, because you may not be a gold bug, but you're a bull on gold because of all the situations that are going on in the world. So now we're switching it over here. We took it up to triple cross, and we are bringing in the predicted high and the predicted low, and we'll take a look at what we would do with that predicted high and that predicted low in terms of helping us manage our trading position. As I said, this is the area where it's going to get a little more difficult, tougher to manage because of the breadth of the dips and the rises. We have mentioned we had the kind of the Dubai day, and some people kind of probably get tired of me saying Dubai day, but this was a big kind of a momentous day in terms of the gold chart concerning, and on this day we had a predicted low for this day of 1200 even. So that means that if we were to change our position, or change our minds rather, we would sell at 1190, and 1190, of course, that was if you were following the prices during that day and you saw that the market was really running down fairly quickly. Whether you would have caught this or not, hard to say. But we're assuming here that if you were a short-term trader, if you were a swing trader, that's what you'd be doing. Would you be doing that if you were a long-term position trader? I'm not sure. There are various opportunities you had to add on to your contracts as the market moved up. So I'm not sure how many contracts you might have held as the position moved up, and you built up your position as each new rise in the market would give you the opportunity to do so. So at this big drop, I think it would probably be prudent for at least a lightening of the position that you have. As I said, I'm not sure how many contracts we would have wound up with, but let's say we had 5 or 6 or something. You might want, because of this sharp drop, you might take your profits on half of them and keep half. You want to stay with the trend. You believe that trend's going up. You don't want to give up on the trend, but you still don't want to give away too many profits. So you want to take some profit, on a portion, on maybe a larger portion of the position. Should you abandon your long view? Well, that's a personal opinion that you're going to have to do. Should you go short? If you're convinced the trend is up, no, you're not going to go short. Remember, you're using the market's money, and I know you're trying to get pretty attached to that money, and you think it's your money, but after all, it is mostly the market's money that you have used to establish the multiple positions. And so all you're doing here by lightening up a bit is to kind of take a little of that off the table, take it away from the market, from the other traders. But there is a question, how long can you hold out? How stubborn can you be, over a longer period of time? And do you have a give-up point? Do you think the trend is dead? There's all kinds of arguments that can go on. If you read the press and look at the TV talking heads, sometimes they can convince you, this day it's up, this day it's down. So you have to make up your own mind. And in this case, we are assuming that you are going to be of a frame of mind where you believe that the market is going up over the longer trend, even though you've had this steep decline and the market starts to go down here. You might say, well, maybe I better lighten up some more. How much you do and what you do will probably be up to you. But if we get to a point like we have a point in here where we have a kind of a significant low, once we get kind of past that point, now we don't know how, if that is the low, but as the